There's my favorite numbers. Core PCE. Well, 2.9%. Nothing really shifting. This is actually wrong. It's the BOE Personal Income Index. But let's take a quick look back here and just go right to the news. One of those big news blogs. All right. Nope, can't sign into that. Another paywall. Let's see. Hold up. PCE. It's on. I know it's on CNBC. Do we really want to read CNBC? Well, we're going to have to. All right. PCE coming in at 2.9%. As expected. That's the most important thing that we'll be looking at today. All items at the annual rate of 2.6% and monthly gains of 0.2. So this is all very critical. We'll be talking about how this is going to impact a lot of things today as we move through the day. We're going to talk about morning momentum. We'll talk about the PCE and what's next. Good morning, David. Good to see you. We'll do the runner at 9 o'clock, and that includes a late scratch, everybody. I apologize, but we had something that was breaking out, broke under its 20-day moving average. It gets scratched. It doesn't get to run the race today. Them's the rules. All right, 8:47. A couple more people still coming in, so we'll give everybody a couple of seconds. Make sure that I see hello to Jeff in Houston, who I know just got in here as well, and TP and UK Ray. All right. So why do you join us every day? You know the answer. Because a day like today, when the PCE comes out and we have the jobs report coming out next week, you've already seen a huge move today already in NVIDIA. 3-minute chart. All right. Big move down to start, 179, reversion at 5:30 in the morning. You're seeing these moves. And again, tech weakness is really going to be back in focus again. So want to be able to know if we're set up for a good day of trading or with strong momentum, or if this is the start of something significant. We'll talk about the stocks that are breaking out and breaking down. This is going to be a very good trading day for a couple of reasons. It's the last day of the month, so we're going to have some rotation heading into September. It is an options expiration date, so we have tons of very liquid stocks with potential reversions. We had names like Affirm reporting yesterday. Good little lesson about Affirm that I want to share with everybody today as well. We'll talk about where smart money is positioning, and we'll talk about the top screeners, as we always do. Of course, when it comes to momentum, we are focusing on the intraday, and this is from overnight readings. This was a little bit of a shocker because we had a lot of breakouts yesterday, starting to weaken pre-market. Again, this will loosen up today, especially if we do see some strength return to NVIDIA and the semiconductor stocks. But we just have to keep a very close eye on the SOXS, which is now trading at about 4.5% under its 20-day moving average. FNGD, I can't type. Look at that. Moving higher, 4.4%. So the weakness is not at the top end of the S&P 500, and that's really what matters most. If we just do kind of a poor man's analysis of this, just looking at the technicals, what are the stocks that are up on the month? What are the stocks that are breaking out above 5% over the last week and a half? Just capital flows, money in and out, paying very close attention to the net side of this on total aggregate. Well, the number of stocks coming down intraday overnight, just again, pretty weak. But as you could see, market capitalization here, 69.36. So the strength is at the lower end, obviously, of the S&P 500. And what we want to know is it coming from the upper bound? Meaning, is it up toward those top 10, 15 stocks? And right now, 5 stocks, it's not, right? $60 billion offset. So again, we know that the FANG stocks are not the core driver here. That gives us a little bit of protection and certainty that there's nothing bigger and broader happening in the next 3 to 4 days, particularly when it comes to liquidity in the market and the unwinds that we have seen. So that's the poor man's way of doing it. SPY strong, NASDAQ strong, Russell strong. All right. So we slipped ahead of the PCE. We got the PCE numbers, and now as we pay very close attention to TradingView and look at the SPY, we will see where we sit as we move into the day. So we have the 8:30 announcement. We had to push up to start the day because, remember, the first move is usually the wrong one, then a little bit of selling. We are 22 minutes in since that announcement. We will see if this becomes a sell the news event, because once again, the expectation overall was that this was going to be very critical for doves. and whether or not we were going to be looking at rate cuts in September. Right now, 87% probability of a rate cut. Expect this number to move around today. The more important number, of course, is October, and whether or not we are going to be moving down a total of 50 basis points by that next October meeting, because again, seasonality, concerns about the economy, the jobs report next week is going to be absolutely critical. A hot jobs number could mute this expectation for October. A weak jobs number, all but certain that we will start to move toward that higher that increase in cuts, 50 basis points into October. And why does that matter? Because, well, we have to actually worry about some recessionary fears, but bad news becomes good news because we're going to look at what's going to improve the collateral multiplier in the financial markets and what can lead to more crowding in the fangs. This is something that happened back in 2021 and 2022. We'll constantly be monitoring this, but once again, as expected, the key thing here is the tech names starting under weakness. Dell was down, Marvel was down, sliding on weak forecasts. That's very important to note. NVIDIA has again flagged China risks despite their strong earnings. The PCA remains the Fed's preferred inflation gauge. Remember, we get the CPI toward the second week, and then we are followed by the PPI, which is the Producers Price Index. Not wholesale prices. It's not wholesale prices, CNBC. My gosh, for 30 years you've gotten this wrong. The Producer Price Index is not wholesale prices. CPI, the Consumer Price Index, is an important gauge, but the PCE, which is what the Fed typically utilizes, is a good indicator as we move toward the jobs report, and then we start barreling toward that September meeting. Volatility trades going to be expected in the next couple of days, particularly on the SPY and the Qs. Pay very close attention to what Don is telling everyone about volatility. Again, weakness creates weakness post earnings. So some of these other tech names, Marvel and Dell, we're either looking for reversions or absolute continued weakness in these names. And look for rebounds. Look for the opportunity to trade those reversions that we've talked about time and time again with NVIDIA. And what we're focusing on here is over a trading view. We are looking for the stock to peel off today, hopefully during actual trading hours, not in the pre-market. This is where I would have loved to have been able to do something. But if we get down into that 177 to 177.50 level today, due to any level of selling or profit taking, just pay very close attention and remember the words of Stanley Druckenmiller. The algos are programmed around deviation bands and have been stepping in and bidding when we get down into these third and fourth standard deviations. You're looking for names like NVIDIA today to potentially revert. If there is a sell-off, you then buy here at the money and look for a move back to either volume weighted average price or to the 20-day adjusted moving average within the Bollinger Bands. And once again, on a day like today, Friday, where options are expiring, just simply using a very in the short term, in the money, 0-date option can be very, very profitable. But you have to be diligent about this. Very, very diligent. All right, 8:54 runner will be in 6 minutes. The Fed's Waller has backed the rate cut path, right, signaling support for 125 to 150 basis point rate cuts in the next 6 months, beginning as soon as September, depending on the data. That is significant, very significant. So if we go back to CME Group and we start looking out 6 months, we're into March. We're getting into March. 125 is right there. 3%. Now, that is very good for long-term for leverage. That's going to be good for consumer defensives. It's going to be good for stocks that are under pressure because of interest rate costs and concerns about a lot of other things. But what about the inflation numbers? And that's going to be the question moving forward, is how much the Fed is going to be willing to tolerate inflation to protect the jobs market. That was the theme of the Jackson Hole speech. It wasn't explicitly noted, But once again, they are choosing the path of higher inflation and abandoning some of their previous tools that they had utilized in 2020. This reinforces the dovish stance on the Fed. This could anchor yields lower. This can boost those rate-sensitive sectors. We're looking at long-term bond ETFs like the TLT, overweight utilities like the XLU. And again, this is very beneficial for the utility sector, which is going to benefit not only from the AI trade, but also from the fact that as yields decline, their cash kickoff is more attractive. And look at the regional banks for upside, but be very, very aware that if you're trading the KRE, you want to make sure that you're doing it around those key moving averages, 20 and 50-day moving averages. Strength has been here. This can be, with a rate cut coming, a potential sell the news event, because if these things get too strong and overbought, we have seen some selling. So be sensitive just to this and look for opportunities as they emerge, particularly if we retest these key moving averages. All right, final thing before we get into it. This has been a little bit of a source of frustration because, again, I have been early. I tried to go first over the wall, and we continue to see overbought territory right now with the OILU on the MFI. Now, I remind everybody that when we get into overbought territory on both the RSI and the MFI, this is bearish for oil. This is where profit taking takes place. You can see it happening right here, November of earlier this year. You saw it happen here in January. You saw it happen near here, right here, back at that March 26th level, and then once again back here in June. So we're approaching this point, which means where do you look to short? The oil and gas expiration, that's upstream. And you have two options. You have DRIP, which is the bearish ETF, which is now moving into oversold territory, where you start to approach these names once again like Apache. You start to look at companies like Devon. You start to look at companies that are very high beta that are already overbought that could potentially turn around. This is a contrarian trade, but the signal is here. Oil markets are pressured by supply glut worries. OPEC is going to add 550,000 barrels per day in September, and summer driving season is over, all at the exact same time that we have overbought conditions on the OILU. So energy equities and inflation expectations are obviously closely tied to oil price trends. Look to the OILU for clues in the next few days. And if we get overbought, make sure that you look to either take profits on anything you were long on or start to look to short in the upstream or even in the oil field service companies, which again will react negatively to falling oil prices and people taking cash off the table from recent rallies in the E&P space. So very critical to be watching this. This is setting up for a very good trade in the next week, week and a half. Again, it's all about positioning and it's all about profit taking, and we are stretched right now at the moment. Sounds like a good time for the U.S. to fill up our strategic oil reserve. I think we could probably do it a lot cheaper, potentially in the 40s. All right. 9 o'clock can only mean one thing. We don't have any music. What do we have?
What you do in your father's garage?
Nope.
Here in New York, they trade everything.
There you go.
Gold, silver, platinum, heating oil, propane, cocoa and sugar, and of course, frozen concentrated orange juice.
All right. So at 9 o'clock, we always do the runner. We step in with our master sheet. We had a scratch this morning. We had to take it out. And again, we had Jack in this line. And just real quick, just so that we know, a little bit of a late scratch on Jack specific, popping back under that 20-day moving average. We had some strength here on the MFI RSI, just could not get back above that 20 and that 50-day moving average. So we'll let that one marinate for a little bit of time. On the momentum side, we are looking at glue. We keep bringing up horses and glue. This is not good. All right. Here we go, taking a look at this RSI MFI strength. This is a light move here, and again, trying to find something that can potentially really break out and start to climb. This will trade a little bit sideways, but we've seen where it kind of consolidates around these key moving averages. We've seen some moves, not massive moves, but when you have a stock trading at about 460, the opportunity for an upside move into, say, the mid fives or even back up to 6 is very apparent. So got to keep this at a very tight stop. Buying the stock at 468, or forgive me, 483. Stop back at around 4 to 5% stop. Looking for continued momentum, trying to stay above that 50-day. Possible move back to that 200-day moving average would be just fine, right? A 10% move would be fine with me. On top of that, we have SLVM. I don't know if anybody's noticed, but some of these things are really trying to turn a corner on basic materials. These are names that have been beaten up on inflation concerns and have been beaten up once again by higher interest rates. This is a cheap stock by traditional metrics. Price to cash flow under 10, EV to EBITDA under 5.5. So it's a value name, right? It's a value name. And the question is, can it get back off the ground? At some point, these names are going to start to revert back to the upside, particularly in the material space. So why not give it a go? Why not set the buy at 40, the stop back at 45, and just try to see if we can get this to become a momentum name over time? You've seen some very strong moves historically. This just kind of goes up and down, up and down, up and down. But from a cheap perspective, what we're looking for, cheap and strong. So we're cheap. We're starting to see some strength. If this RSI can hold, if we can continue to break out, it may be a slow burn, but it could be a very nice slow burn back to the $55 to $60 level. We don't have a drum roll. Wouldn't it be a horse? It's a horse. There's a horse racing theme. We should have some. I'll work on it. I'll get to it. STX is its strength. Seagate Technology. We've talked about this. Just pure momentum on the tech side. Overbought at the moment, but again, as you could see, overbought can get more overbought, and we have continued to see strength here. So Seagate is in play. Interesting potential name here for just selling a spread to the downside, looking maybe under that 20-day moving average, or even as far out to that 150 down to 145 levels. In addition, I'm going to be talking about this with my Tesla crew in a little bit, but the strength is just blistering here in these consumer cyclical names, particularly on the cruise ship stocks. Very rate sensitive names, and obviously very expensive, but just pure momentum, particularly coming off of the April move. These names just continue to remain hot, and you just want to make sure that you trade it with very tight stops. Not much more than that. WDC, Western Digital's back in focus as well. Just continued smooth, strong momentum, keeping tight stops, making sure that you're staying in the money, going out 2-3 weeks. And if you want to reduce your risk, buy in the money, sell out of the money, look for a high probability of profit in the 50 to 60% range, and keep your expectations muted at aiming for a 30 to 40% gain instead of 100% gain based on a lower probability of profits. On the weak side, Williams-Sonoma is just, this is just, again, another continued hammer that continues to move lower. If this goes under this 50, there's a lot of downside here, right? So WSM, same strategy, same thing that I keep saying over and over again. Buy at the money, sell out of the money. Buy in the money, sell out of the money, and use these levels back here as your potential stops in the event that it reverts back above that 50-day moving average. On top of that, we've seen this thing get absolutely rug pulled. Newegg Commerce. This is the definition of a rug pull. And you could see how bad this has gotten in a week. There were a lot of bag holders. There were a lot of people trading this momentum. There were a lot of people who weren't paying attention. And now there are a lot of people who are paying the price. Newegg has downside to 26. 26. It's not going to get any better. Just one of those things where, again, you always want to pay especially in these events where you have these massive moves up. Always pay attention to these core indicators. Negative crossover on that MACD after that huge drop down. MFI dropping back down to 52. RSI crossing over negative here. It becomes a short back at the 20. We've had a huge move lower. IVR is going to be monstrous on this. But once again, market cap, there's probably not even an options chain on this. Some of this stuff. This is just a stock that people are probably borrowing at 10% to short. It's don't try to catch this falling knife right now. Meanwhile, on the other side of momentum, it's just pure momentum on uranium. Same thing, continued strength, AI trade, great numbers. You can go across the board on all of these types of names. Energy fuels, very strong momentum. But URA makes for a very compelling long case, as usual. It seems like, the speculative money that really poured into this back in 2024. Now the use case is starting to be identified, and we've seen this not just with the uranium stocks. We've seen a lot of this with the AI infrastructure names. So energy has been breaking out a little bit, particularly on the natural gas side, looking for natural gas, BOIL, to break above this 20-day moving average. If Boyle can get back above this around $30 line and start to show us some strength, that's where we're looking at UNG, the U.S. Natural Gas Fund. This is all setting up for next week. We'll be digging into a lot of these things later today at 3 o'clock when we are live for the final hour of the week. But very intriguing play here if you are looking to potentially go short oil and long natural gas on a pair trade. In addition, tech stocks getting a little bit of strength finally, continuing to bounce back from that brief sell-off that we had, that retest of the 50-day moving average. XLK remaining strong. Tesla looking more like a breakout stock at key levels at 352, possible move up to 368. But again, a lot of weakness in the future if we see continued bad news out of Europe. And finally, just looking again at the weakness on the LABU, pay very close attention to the biotech names. If the LABU breaks down, we'll be looking at to short a lot of different biotech names moving forward. All right. GME squeeze, storage hard drives used in the AI data center. And I'm getting a question about EXP, Eagle Materials. It's holding the line, holding the 20, holding the, you got key, you got support and support. See if it can hold. That's a little concerning, but don't know much about good old Eagle, EXP. Wonder why the cost in Washington State is near an all-time high. I would assume it has to do with the lack of refining capacity on the West Coast and taxes. All right. LABU needs to moon. All right. Iron Condor on USO. I will not trade the USO. I don't trade it because it's a fund based on futures. And this will detach from its net asset value pretty quickly. No. NYMEX. Yeah, that's a tough one. You could just, you could just go into the upside of all of the, what is that? I forget the name of the damn thing. Selective U.S. Oil Index. And that has all the top 10 oil and gas producers. You could do an Iron Condor on Exxon. All right. 910. All right. So now that we got 10 minutes to ourselves, very exciting. Last weekend of the pool. By the way, did anybody else notice that silver is like at 40? Did we not call this? Did we not say money printer, money burr, gold moves higher, silver moves higher? It all moves higher. This is just a reminder that when it comes to silver, Okay. All you need to do is trade around these key moving averages. And if you bounce off that 50, just go long. And especially if you bounce off that 200, definitely go long. Silver miner ETF continuing to rise. Gold GDX doing fine. Hey, they're printing money. They're loosening economic conditions. It's the loosest economic conditions since COVID. And that means loosest economic conditions since January before COVID happened. And they're going to start cutting interest rates. Yeah. Okay. I like BABA today. I really like BABA. We were talking about this all week. I think this can run to 140, maybe even 150. And I just want to see the options crush a little bit and then going long. So yes, pouring gasoline on the fire. Economic conditions index, right? Chicago. All right. Now I want to remind you of something. This is one of those things that people look at me like a dog hearing a whistle for the first time. But this is the economic conditions index that Chicago does. There's different readings that I've said that we're looser than any point since COVID. Technically, late July in the Chicago index is the loosest, but there was a reading out of Goldman suggesting otherwise, which I'm going to go with. This chart right here is your combination of risk, credit, and leverage in the financial system. This is COVID. This is where the market crashed. This is October 2022, where the gilt crisis happened and interest rates were elevated. If you flip this chart over and you go on a 5-year dart, it's the exact same chart as the S&P 500. Literally the exact same thing. And there's a reason for this. It's because markets are front-running liquidity conditions. I keep arguing this until I'm blue in the face. But let's go back here. Let's just go to January 2020. We'll go to here. We'll confirm that. There's your dip. There's your rally. There's your rollover. There's your continued run. There's your dip. There's your rally. Here's your dip. Here's your rollover. Here's your run. Here's your dip. Here's every single short-term liquidity event that we've had going back to 2022. Here's April of this year where everybody panicked, and look how loose the economic conditions actually still were compared to the gilt crisis. And there's your sell-off. Here's the gilt crisis. Here's COVID. It's the same thing. I feel like I'm taking crazy pills. The front-running economic conditions. Okay? So, or liquidity conditions. So when I see in Seeking Alpha these articles, we're in an everything bubble. Yeah, I know. But here's the problem. People don't take the step back to actually understand what the hell is actually going on. The United States is 75% of the world MSCI index. Okay? It was 30% back in the 1980s. It has rallied from the big sell-off that we had in 2008, and it has rallied from roughly 48% up to 70%. It has done so because we printed a ton of money. Our money supply continues to expand. Liquidity continues to expand. Capital in the financial system continues to expand. And that money has to go somewhere. So the people who are saying we're in an everything bubble are typically the same guys who said 2009 was a fake recovery. 2011, they said that QE wouldn't work this time. 2023, they talked about the taper tantrum. 2015, they talked about Chinese deflation being the destruction of everything. 2018, they said, hey, the bond market is crashing. I was right. 2020, they said you can't print forever. 2022 said they can't print again. And then today they're saying everything bubble. Maybe the United States is the bubble, right? But people are missing the greatest wealth transfer in history because we continue to use 1929 thinking in a 2025 market. This is a totally different world. Remember, in 1929, the Federal Reserve was not focused on liquidity. This all happened in 2008 when Bernanke was in charge, and Bernanke, being the scholar he was, put that in quotes, said that, the challenge was liquidity in the system. But there was so much leverage in 2007, 2008 that unwinding it all created all of these huge air pockets in groups like AIG and a lot of these mortgage groups and a lot of these shadow banks. So what did they do? QE1, QE2, QE3, QE4, and be very confident that QE5 is coming. Might not be in the next 6 months, but it's coming. And it's going to be to ensure that there is enough capital to refinance all of the debt in the global financial system. That's what this is really about. There's $185 trillion in global liquidity, according to Michael Howe, and about $305 to $310 trillion in debt. And all of that debt never gets repaid. It gets refinanced. And it gets refinanced, and the liquidity figures go higher. And while that debt is moved around, again, one person's debt becomes another person's asset. That money is then effectively turned into something to either create leverage or in order to buy risk assets. The everything bubble is not a bubble. It is a reflection of capital in the system, capital that continues to flow into the system. And I just remind you over and over again that it takes a lot of money to drive a market from 115 on the SPY back in 2011 up to 650 today. And where was the big catalyst? The Tax Cut and Jobs Act back in 2017. So the reality is this. They're going to continue to print. The S&P 500 is more likely to hit the SPY is more likely to hit 1,000 in 2030 than it is to go back to 300. Because if it went back to 300, we're going to be not focusing on trading stocks. We're going to be focusing on trading bullets and green beans. So once again, the purpose of the market is the outcomes of the market. The outcomes tell you what this system is about. A system is designed to create specific outcomes. And if you find out what the outcomes are, you can reverse engineer the system itself and say, oh, it's to constantly refinance debt. It's to constantly print money. It's to constantly ensure that we do not have debt deflation spirals around the world that will tear down a country like China, like what happened back in 2016 when the S&P 500, through no fault of the of U.S. investors, absolutely tanked 20% in about a month and a half because of China's debt deflation situation. And if you think that we are immune from these types of events, I remind you that we had the Japan crisis that happened last year in August, but this sell-off right here in September was entirely tied to China's debt deflation problems. And China has been loosening its financial conditions since then. And Japan has been doing the exact same. And we've moved away from deflation in Japan to inflation in Japan, which is actually driving investors to move to risk assets rather than ultra-safe bonds that were paying virtually nothing. These events will happen again. There will be more policy changes. There will be more money. And it is your job to stay ahead of the debasement of the currency and to stay ahead of whatever the inflation number actually is. Remember, I said when I was on Josh Brown recently that there was a metric that was done on New York City. We were talking about the upcoming mayor in New York City. Inflation was not 3% in New York City. Inflation, according to the Chapwood Index, was 12.2%, compounding for 6 years. And that was by simply buying the things that people buy, the top 250 things that people purchase. There's going to be more money printing. There's going to be more capital in the system. And once again, we're going to have these very bearish events. We stay out on top of them. But for the most part, the bias remains up and to the right. More money, more capital, more printing, higher asset prices, higher gold prices, higher silver prices for the future. Different way of looking at the world. Don is up now at 9:20. I will be back at 3 o'clock, and we're going to be at the Still today. We're going to shoot it from the bar, give that a test out, see what that looks like, and we'll go from there. So I hope to see everybody there. If I don't, I'm going to be back on Tuesday Remember, markets are closed on Monday, Tuesday at 8:45. So I hope you all have a great trading day. Don's going to throw in some music. We're going to go from there. Have a great day, everybody.